I'm Sage Revell. I'm a partner at Brown Rudnick. It is my pleasure to be joined here today by this wonderful panel. We're going to be talking to you about digital asset fund formation. So I'm joined here today with Dr. Sachin Jaitly. He's a partner at Morgan Creek Capital Management, and also Sarah Brennan, General Counsel at Delphi Ventures, and Larry Florio, General Counsel at 1KX. So I'd like to kick off this discussion by just asking each of you to tell us a little bit about yourselves, a little bit about the funds that you work for, and we'll take it from there. So Sachin, why don't we start with you? We'll take it in this order.
Sure. Happy to be here. Good afternoon, everybody. I also just want to give a special thank you to Scott Smettersman, who's also a partner here at Brown Rudnick. He's been my outside counsel for the past 6 years, a bit of a therapist, a bit of a life coach, and just want to tip my hat to him. So our firm has been around for 20 years. In the last 6 years, we've initiated a digital asset practice, investing in venture capital startups in the blockchain ecosystem, as well as digital assets themselves, the liquid assets. And so to date, we've invested over $400 million in about 80 companies. We have now launched a fourth vehicle, a venture capital vehicle, to raise about $500 million to invest in an incremental about 30 to 40 companies. And it's been a very exciting chapter of my career personally. I think this is as many of us expect, the next iteration of the internet, but perhaps our 90s moment of our career in terms of creating value. So thank you.
Great, thank you. Sarah?
I'm Sarah Brennan. I am over a decade corporate and securities lawyer, and I am very active in a lot of the policy work in this space, primarily through an organization called LexPunk, which is focused on sort of promoting and advocating for builders in the space. Delphi Ventures is a mission-driven capital allocator. We're not a traditional fund. We are really focused on making crypto happen better and faster than it would have without us. And so in crypto, when you're deciding whether to invest in something, we always have a gut check on, is this something that is important and good for the space? We're not, over here in the meme coin arena trying things out.
Fair enough. I like that reference. Thank you. Larry?
Larry Florio. I'm General Counsel at 1KX. 1KX has been around since 2018, focused exclusively on the crypto space. We manage a little under $800 million now. Depends on what Bitcoin's doing today. That's across venture capital, liquid, and we also invest in NFTs, which may or may not be art, depending on who here you're asking.
Thank you so much. So can we just start actually with got a basic question for you, since this is a digital asset fund formation panel. What are the different types of digital asset funds? Larry, why don't you give us your thoughts and overview?
Oh, so many. I guess from a more traditional finance perspective, you have registered funds, like we now have the spot Bitcoin ETFs. We have private funds, such as the kinds that we all work with in one form or another. There are also just, I'll call them YOLO multisigs, which are really just people throwing money together in a wallet. There's no real legality or formality around any of it. It's just investing in stuff. I think Jason Schwartz kind of mentioned he's doing something actually like that with some friends investing into NFTs. And we see a lot of that actually in the space, far more than I think most people in traditional finance are really aware of.
So on that, I only learned YOLO multisigs yesterday, and I thought you were kidding. That doesn't sound like a real thing, but it's a real thing.
I wish I was kidding.
I looked it up. So can we just talk a little bit more about this? So, from a legal perspective as well. So this is effectively pooling money into a single wallet, and there's obviously the ease of use there, but there's no legal structure.
No.
So, exactly, but that's a problem. So
yes.
So how do people deal with that? In practical terms, what happens next? You put money in a wallet, and there's no governance, no regulatory,
I think there's one of a few things that happens. I'll say there's three things that happen. One is they lose all their money. That's usually probably the most likely outcome here, so none of this really matters.
So why do they do it?
Oh, it's fun. Or they thought they were going to make a lot of money. I mean, like, this is a highly volatile space. There's lots of highly speculative activity, especially right now with things like the meme coin craze. You hear stories about people taking $100 and turning it into, $100,000, $1 million. This is actually happening right now. So everyone wants to roll the dice in the crypto casino. Not everything in crypto is a casino, but there's definitely some gambling aspects to it in areas like that. So why would you, if you're trying to throw in a few $100 maybe, are you really going to go through the pain of, you're not going to form an LLC, open a bank account, apply for a tax ID, and then go through all that so you can then onboard with Coinbase, and then you can on-ramp some fiat into USDC or ETH to go on chain and actually buy something. No, you're going to take a few bucks, you're going to start a new wallet with some friends, and you're just going to go and do it.
Okay.
And the less incendiary version of that is there's always been flavors of investment clubs throughout time and like pass the hat kind of structures. And it usually, on the more casual side it's friends. They're just pulling together and someone deploys. And then, on a broader scale, people have tried to take these investment club structures, DAOs, on chain, right? And I think a lot of the startups that did that found out there was a lot more complexity there than they realized, and there's been a lot of experimentation. A lot of those on-chain DAOs weren't like collecting, money up front or saving it for taxes, tax reporting. So there's been a lot of experimentation that kind of went left over time, but there's, a continuity there in sort of these more casual investment structures. It's not a new phenomenon, right?
Got it. And so very, very high risk, but possibly very, very high return. So that's really how you can place it. So I think in contrast to that, Sachin, you were talking about the sort of perhaps some more risk averse investing into your fund. You say pensions actually sometimes, not sometimes, they have to invest through funds like yours. So can you tell us a little bit more about that on the other scale and actually how there's a little bit more of a structure and regulation around this?
Sure. So we do have pensions who are part of our LP pool, and they cannot, by their own mandate and by their own policies, go out and purchase digital assets. And in some ways, they can't go directly on cap tables in blockchain startups. So they have to go through the likes of us. Now, this obviously creates an opportunity for us, right? But they will allocate dollars via our vehicles. We also are required, we cannot custody our own digital assets, right? Even if we had our own ledger wallet or cold wallet, we would have to use a qualified custodian to deposit and to custody. And I will call out a party in the room, Gemini, which is also one of our portfolio companies, but also we have the institutional head of sales here, Claire Chen, who I advise everybody to go and speak to. She's lovely. And so we custody our assets with both 50% Gemini and 50% Coinbase. We're investors of both companies. And so they're mandated to go through us. We are mandated to custody with digital qualified custodians. In addition to that, I'd also fear that LPs, our pensions, don't want to also mark daily, right? They don't want the daily volatility. They want to mark quarterly. So our reporting structure to them, marking on a quarterly basis, and we do at the end of the quarter, the price of Bitcoin or the price of the digital asset, we report back to them. And that helps them smooth out their reporting structure on their end. So it helps them from their own constituency base in terms of the communication, but it also is factored into their own policy, requiring them to go through us.
Okay, and so obviously we've got the pension funds, and they're in my mind quite risk averse. But are there certain types of investors that are better situated to invest in digital asset funds than others? I'd sort of, I guess, open the floor to anyone for that.
I mean, I think you have to have, as an investor in this space, you have to have a certain maybe heightened risk tolerance, even compared to a lot of other investing. It is, but whether it's by its nature or not, it is a highly volatile space, especially when you're on the liquid side of things. So I think that even with that quarterly smoothing that can happen with the reporting versus actually holding it spot yourself, you do have to accept that there's going to be times when your portfolio is up like multiples, not just percents, and there's going to be times when it could be down like substantially from those highs. And we've seen these cycles repeat time and time again. And it's not for certainly not for every pension. It's not for every even just sort of high net worth investor in the space. You have to accept that there's going to be years you're up 10, 50, 100x. There's going to be years you're down 95%.
So do you think the volatility in the market is effectively what's driving the current state of fundraising right now, just based on, sorry, it's probably a touchy subject for some people, but let's talk about that.
It's getting better.
It's getting better. Okay, there we go. So it's not all doom and gloom.
I think everyone in the room understands our macro market enough that we are 2 years favorable, 2 years less favorable, right? And that's been cycling through. And let me actually just paint the picture real quick. So every 4 years, we peak and we trough, right? 2013, there was a peak. 2014, there was a trough. 2017, there was a peak. 2018, there was a trough. 2021, peak. 2022, trough. As we stand here today, 2025 will be a peak. 2026 will be a trough, right? But each peak is greater than last peak. Each trough is greater than last trough. So we're in the upward and to the right trajectory. So if you think about that, if you break that down on a fundraising cycle, every 2 years, the sentiment, the media, the attention is favorable toward us. Every following 2 years, it's unfavorable. And so we are going like this in these cycles. Right now, we're in this bull cycle, and this bull cycle will last, by my prediction, toward the end of 2025. 2026, the media will say bloody murder, sky's falling, run for the hills. But we have this 2-year window stretch of a bull market to go raise the capital in a favorable environment, and then it'll get tough again.
So what you're saying is people should invest now.
Well, that's another, you want to be contrarian in a certain way because the price is now. Yes, you should invest now.
Yeah.
Just leave it there.
There we go. We just wanted an answer, so thank you, and we will.
Let's go with that.
And I think there's a lot of different flavors of funds, and there's definitely more crypto native funds, and crypto native LPs would be people that transact on chain and can handle getting distros in kind,
yes.
and can handle sending and receiving crypto, and then there's more institutionals that are giving people that are less crypto native a degree of safety and that sort of thing up the scale.
Okay. It does seem like a very volatile space, even with the more regulated side. So okay. So moving on slightly, actually, I wanted to go back to the wallet discussion. So Larry, you and I talked about this yesterday, but we talked about hot and cold wallets, and I didn't know that there was a difference between them. And so I think maybe if you could just explain the differences and what that means, then that would be really helpful, and we can go from there.
Sure. So at a high level, a hot wallet is one where the private key is exposed online. So that would be something like MetaMask or Trust Wallet or Coinbase Wallet, not Coinbase Exchange, where it's really just a browser extension. So if your computer is hacked, there's a higher likelihood that your private key is stolen. Your private key is what you need to actually transact with that wallet. Versus a cold wallet, where that private key is never actually directly online and connected. It's on something like a ledger or another USB device, where you enter a code on there. It will confirm that you have the correct private key, but it's never actually exposed to the internet itself.
So that seems safer to me, the latter, but then if you lose it, then it's gone.
Not necessarily. As long as you have, so there's this handy thing called a seed phrase, where it allows you to recover the wallets that were created from that seed phrase. So if you lose your ledger, like your hardware wallet, then as long as you still have that seed phrase stored somewhere, you're able to recover those. And actually, you have to be careful with that because there are some horror stories of people who didn't realize that they were putting their cold wallet seed phrase into a hot wallet, and now it is no longer a secured cold wallet. It's just sitting
really,
there.
Really hot.
Yeah, very hot.
Okay.
And another really big debate is custody. There's a pending SEC rule that for RIAs will mandate third-party custodians, a whole host of things. And one of the tenets of this space is the ability to have self-custody. And government really loves re-intermediating everything. And third-party custodians may be the pick for a specific fund, but it's kind of removing that choice in your best case scenario after paying a lot of fees that the intermediary is going to charge and being exposed to all sort of that intermediary risk is that they're going to use the tech that you would have used in the first place. But those tech developers have a much smaller total addressable market. So there's all sorts of debates here, but I like letting the tech do what the tech is supposed to do in this space is just like kind of a unifying thing. That's what we're trying to make happen here. And that is true in custody too. There's non-custodial solutions that are more like multi-sigs, and they're still developing the tech that can sort of safeguard assets and provide visibility as those features kind of develop. You can have like auditability as well without using custodian.
If I could just jump
Yeah,
in there.
please go
So I think each one of these major peak and troughs that I was describing earlier, in my opinion, have a core lesson that come out of it. So in the 2013-2014 cycle, there was a one exchange that went down, and it took down almost the entire industry. That was called Mt. Gox. In my opinion, the learning from that cycle was about security. Right? And it was hacked, and that's why it almost went down. The second cycle, the 2017-2018 cycle, was the big IC boom and bust. And I think the big learning was, how you fund startups. Don't do ICOs is probably the better idea. This third cycle that we were just a part of, which was 21-22, I think it's about custody. I think the big learning, and this is my thesis, is still playing out right now, but I'm seeing a wave of new custody ideas and solutions, multi-party custody, MPC is often it's called, or multi-sig solutions, non-custodial solutions. And I'm starting to see a lot of startups, a lot of great entrepreneurs gravitate toward that space. The reason, by the way, I think this is the big learning from the 2021-2022 cycle is because so many people were locked on FTX or all of the Voyager, BlockFi, Celsius, all of those platforms that essentially went down. Now, there was another common theme there, largely around centralized lending, but I think the bigger issue there was around custody and how you control your own destiny. As our industry says, if it's not your keys, it's not your cheese. That's a core mantra around custody. So I think you're going to see a lot of creative ideas come to fruition in probably the next couple of years.
Okay, thank you. So can you explain what it means to tokenize a fund? So how tokenized funds differ from non-tokenized funds? Anyone want to take that? That's just to the floor. So whoever wants to jump in first.
Sure. At a high level, if we're talking about, I'll talk about this in a private fund context because that's really where primarily where we're seeing that right now. I mean, at a high level, it doesn't really change anything. Like the fund is still going to operate exactly how the fund works. You're not going to have like a Coinbase listing for a private fund's token anytime in the foreseeable future because it's still subject to all securities laws and exemptions, tax regs. I mean, there's a whole slew of things that you're just not going to see it anytime soon. And I don't think that's a bad thing. So in some ways, I think that tokenizing a fund right now is really sort of a proof of concept test to see whether you can do it. And I think it's fantastic seeing these institutional players dip their toe a little bit deeper in the water, not just maybe like researching Bitcoin or even doing a spot Bitcoin ETF or something like that, which I think is actually fantastic for the space and adoption in general, but seeing them try to actually deploy using this technology. My initial reaction when I saw that BlackRock was doing one of these was a little bit of like why or so what? Who cares? But as I thought a little bit more about it, I kind of revised that to, all right, this is actually a big deal because here's a real benchmark for the industry that's at least trying this out. And I think that there's a few others. I think it's KKR, Carlyle did one as well. I think Franklin Templeton is playing around with this also. And it's a signal to the industry that this is a technology that's worth pursuing and worth actually investigating to see how it can be leveraged, even if right now it doesn't change the practical administration or operation of a fund.
Okay, thank you. Anything to add on that point?
Sure, I'll happily jump in on this. So KKR has done some, I believe, on Avalanche, and Apollo also recently did some on both Avalanche and on Provenance. And so I think we're in the early days of tokenization, digitization of funds. I see one of the nice benefits of this is having LPs having the ability to create liquidity if they so choose to, right? If you want to, right now, if you want to create liquidity in an e-liquid fund, you may have to sell in a secondary market if you can find a buyer. If you tokenize a fund, you could have the opportunity to sell on-chain your interest in a fund. And so that creates an interesting opportunity for LPs. I would argue that we're probably still in the early days of this journey. There's several great companies working on this idea. We have backed a couple. And I hope the adoption curve is going to be faster than what I just said. But my intuition makes me believe that we're in the early days of this cycle. And by the way, just in terms of the way I think about the cycle, if we think Web 1, Web 2, Web 3. So Web 1, 1990 to 2005. Web 2, 2005 to 2020. Web 3, 2020 to 2035. So these 15-year windows is where we are, in my opinion, for Web 3. So we're still in the earlier days. I think tokenization of funds with very conservative LPs, including pensions, are not going to push the gas pedal down until later in the cycle.
All right, thank you. So, Sarah, I'm going to ask you this question next. What advice would you give investors when looking to invest in digital asset funds? Like, what are your sort of, top tips?
In funds?
Yeah.
It's an interesting one because we don't seek LPs.
Or maybe, the advantages or disadvantages or just things to watch out for.
I mean, I think that every fund is a genius in a bull market. Mm-hmm. I think you have to have a high risk appetite. I think I do think that like every fund out there has its own flavor. They have their own brand, thesis, et cetera. And that kind of has to be a match. And how they do business kind of like has to match your risk appetite, your investment, I don't know, like some people are NFT investors. Those funds last cycle went straight to zero. But if that's your thing, you collect art NFTs. And you're okay with that, it just depends on your personal investment goals, I guess.
Okay. Any advice from you guys?
We're accepting new investors.
Yeah. Okay. So what would you say to them? I mean, this is your chance. So.
Yeah, I mean, I think Sarah actually got. I don't honestly know that the things that you would analyze or consider looking at investing in a fund that's focused on digital assets is necessarily that different than what you would look at for a fund that's investing in any other sector. You're going to be talking about their investment thesis, the team, the sorts of the research process, the deal sourcing, if there's any valuation discipline, and I do mean if there's any valuation discipline, especially in up markets in this space.
Fees matter.
Fees absolutely matter too. Who are they using for custody and things like that? Because there's not really market practice in this space yet. So I think these are questions that, especially on the institutional level, investors are asking during the DD process of any fund manager. But I think it's especially important in this space where you do see a lot of people come in and launch a fund, but it's really just them. And does that mean if they're not using an institutional custodial platform, does that mean that they're actually just keeping all this stuff in a wallet and they're the only signer on the wallet? Because I've heard horror stories of exactly that happening. Yeah. People will raise tens, hundreds of millions of dollars, and it's basically them with a big MetaMask wallet.
Internal controls, policy sets.
Got it.
If you want to deep dive.
Mm-hmm. Ask questions.
Yeah.
Thank you. Well, thank you so much. I actually am going to open it up to the floor now if anyone has any questions for anyone or all of these panelists. Who's going to go first?
I have a question.
Yes, Stephen. You want to stand up?
Yeah, sure.
Thanks.
Because I always have a question.
Yeah, of course.
So, this kind of goes back to the panel we had on Dallas norms and on the concept, sort of the technical pieces of the software itself. Are we going to be having conversations on digital asset fund formation in 5 or 10 years, or is the technology going to program this sort of vehicle out of existence? That's part one, and part two is, are you yourselves in any of the projects that you're working on eating your own dog food? Are you using the technology? And how are you using it? So 2 questions, whoever wants to answer.
I'm happy
Go ahead.
to jump in on the yeah. So
Skeptical of you.
on the first one, I think it's always healthy to remind ourselves we are amongst our community of kind of Web3, blockchain, crypto, or however we want to define it. It's still a very small community in the big scheme of things, right? We're talking 500 trillion of real world assets around the world. We're probably 1% of that. Right, in terms of our entire asset class, of everything, every public company, every private company, every digital asset, probably 1%. You go around talking to whether it's CalPERS or Texas teachers or whoever it might be of the pension world, they have very little, right, involved in our space, and not that it's not a willingness to increase that, but where we are today. And so I think on the first question, in terms of where we will be in 10, 15 years in terms of digital asset fund formation, will this still be a topic? I think very much so. I think now is the time to invest around the picks and shovels of our industry, because I can only see it growing over time.
You're saying it's effectively exponential, but it's still at such early stages that you probably will still be seeing this going forward.
Absolutely.
Yeah.
I think it will be, as there are cybersecurity verticals or as there are real estate verticals, so too would be very likely to be, whether it's called digital asset or whether it's called crypto, whether it's called Web3, it will be, or whether it's called blockchain, it will be something branded, but it will be this core infrastructure that we're all working on today. And I expect that to continue over the next 10, 15 years. In terms of the second question around do we eat our own cooking, so partly. I'd say we have a portfolio of about 80 startups. To the extent we can leverage them as a part of our TradFi bridging into this DeFi world, we will. And I'll give you some examples. So as I mentioned earlier, we do custody with some of our portfolio companies, right, or our digital assets, because we have to. So Gemini is a qualified custodian, Coinbase is a qualified custodian, and we custody our assets with them. That's also, it's not only is it are we mandated to do it, but it's also best practice, I believe, to do so. If we had our cold wallet on our side or a hot wallet on our side that got compromised, it would be a problem. So it's much better to have that outsourced to a institutional party that's a qualified custodian. In addition to that, you may or may not be familiar with the idea of staking. So we use some of our partners to stake with, right? Some of our portfolio companies to stake with. And this creates a yield for our investor base, our LPs. And that's a valuable asset too. In addition to that, staking, and by the way, for those that, just to get us all up to speed, what the idea of staking is, you deposit your digital asset for a period of time, and it will generate a yield. Right? And I'll bore you all the details, but that's the long and short of it. Now, to set up a staking apparatus, you need a little bit of hardware, you need a little bit of software. We have a portfolio company that allows you to license the hardware and software. That company's called Block Demon, by the way. Encourage everyone to stake with them.
Interesting
and so
choice of name.
we use them for some of our staking services. And so I'd say in part where we can, we will use our portfolio companies. So hopefully that gives some color.
I have skin in the game.
And I will say to Pally's point, I don't know if he was poking at this, but a lot of people in this space don't see the evolution of VC involvement as a good thing. It's reactionary to regulatory pushback on ICOs, which were seen as more with different degrees of success, egalitarian, kind of a societal Wall Street that's kind of response, open finance, decentralization of finance and access to financial opportunities. And there are proponents of bringing back those models that are flatter. They don't kind of emulate traditional structures. And there's not a great regulatory path forward, no matter what you do right now, as some of you might be aware. So, that's one thing. And then in terms of eating your own dog food, we definitely are users of all of the projects that we work with and invest in. We're kind of deeply integrated. My firm has tokenomics experts. And one project that I like, because it solves problems for me, and my partners will appreciate that you asked us this, so thank you, is Integral. We've had so much pain from fund admins that are in the Stone Ages. So they don't know how to look at transactions on chain. They literally make us copy paste transactions into Excel, which literally, in 2018, I think Deloitte was like, triple entry accounting, this is the future, but no one's done anything. And so that company is like working on that accounting integration.
Otherwise, you just have a middleman, and that's very
Painful.
stressful. And
Yeah, it's stressful.
it sounds like a lot could go wrong with that.
Yeah.
Even just a simple copy paste, a lot can go wrong. So
Yeah, it's really nice when you let the technology do
what it's supposed to do. Yeah. Or anything to add?
I mean, I think that there's always going to be a space for digital asset funds in this sector, the same way that there's still a space for long-short equity hedge funds in the space, even though the stock market is fairly well known and understood by lots of people. There's always going to be subsets of people that don't understand the particulars of the sector,
Right.
or don't have access to it, or don't have the scale to invest in it properly, or just don't have the time to do it themselves. I think those are always going to be factors that make it reasonable to delegate your investing activity to professionals, where this is all they do and live and breathe. So I think that it's going to only grow as the sector continues to grow, the same way that it has in every other sector of investing. As far as to the second question, we absolutely are users of the tech that we invest in. I think one great example of that is Gnosis Safe, which is really the premier multi-sig wallet provider out there right now. And we
love that YOLO multi-sig, don't
This
you?
is not a YOLO multi-sig. So that's
different multi-sig.
No, it's the same technology that is used for that, but it's just technology. You can use it how you want to use it, right? So I talk about YOLO multi-sigs as really just some people casually, again, investment club style, some friends are putting money together. But the technology itself is incredibly robust. It really just provides the same sort of capital controls that we would expect from institutions on a bank account, where it requires multiple people to approve moving money around, but on chain. So it provides layers of security and accountability where they wouldn't be, but they do it in a crypto native way, where you're using the technology to secure the technology rather than on stacking risks that we would expect in traditional finance, like human error from copying and pasting into Excel files, or people just embezzling and things like that, where this allows you to have similar types of controls, which are just good governance, without having to introduce centralization and human error to the process.
Okay, thank you for that clarification. Does anyone have any other questions? Yes, please, at the back. You, yes. You want to stand up? Sorry, I don't know if this is what we were doing. I've just been asking people to stand up. So.
Thank you guys for being here. So one question that I have is, are there any interesting or any industries that surprise you when you're seeing individuals use technology? And just for one example, cloud computing is an area where I've seen blockchain technology come into play that I found really surprising and very bullish. Just curious if you have any insight on that as well. General industries.
I think yes, and I think that's actually a great example of it, but I think we're still in very early days, even in the exploratory stage in the use of blockchain for a lot of different areas. So I think that as we progress from here, we're going to see more attempts to use it in places. And I think we have seen that a little bit in areas where maybe it doesn't necessarily work. Yeah, absolutely hasn't worked, or doesn't necessarily make as much sense. I mean, one thing to keep in mind is that there's always trade-offs when you're using blockchain, right? We talked a little bit about the decentralization trilemma, where you're trying to, I'm gonna mess this up, but it's basically security, efficiency, and cost. And it's really, you can have 2 out of 3. And you're never, from an efficiency for the cost perspective, you're really never gonna beat centralized actors. I don't think that in the near future we're going to see a decentralized cloud computing platform be able to compete with like AWS in efficiency or anything like that. But it does provide other things. You don't have that single point of failure that is maybe Amazon. Maybe you don't want to have to rely solely on a single corporate actor for such a massive amount of your business model. And I think that this allows people to remove that risk. You're adding other ones with smart contracts and things like that in there as well, but allows you to remove that one risk point. And actually, in some ways, what's exciting about with protocols and tokens and things is that by an operator and user of the protocol, now you are really part of like you have some equity in that protocol, which is really what tokens are meant to represent, is network equity. And as a user and of that platform, you're now really becoming part owner of it. And that's where a lot of the tokenization of things originally became really exciting, is because you're providing that value to the people that are creating the value for that platform.
Yeah, and I think I heard the question correctly, but it was about new industries that it's touching, if that's correct. Okay, got it. So I'd say, from my view, there's certain industries that we expected blockchain to lean in and accelerate with that really haven't panned out, and there's other industries that it has panned out, and I'll talk about both of them. So I think in the world of supply chain and to a certain extent in gaming, there was a lot of excitement with the blockchain, and there was a lot of investment as well in those two sectors. And I'd say supply chain to date really hasn't moved the needle in my perspective. And by the way, the technology is readily available. It can make supply chain much better. The adoption just hasn't been there. And I would also, to a certain extent, include like medical health record, right, EMR. The technology is perfectly available and can add enormous value, but there's just perverse incentives in some of those industries to allow the adoption to take place. Now, I think it will happen over time, but the journey is taking longer than expected. Flip side, things that are working really well, fintech, right? That's the obvious one. I think fintech is creating a level of adoption and eating away on the fringes and coming to the core of kind of financial services in a very rapid manner. And we are, very excited by that. We're investing actively in fintech in and around decentralization. And I will also add, a very exotic use case that recently came and hit the headlines we spoke about DAOs earlier in the day. And so there's a spirits company. I believe the spirits company is based in South America and is selling rum out of the Caribbean. But they have launched a new venture arm of the company that is completely DAO, has a DAO that operates the organization, a decentralized autonomous organization, runs this new spirits company, and the CEO of the DAO is fully AI. There's no human involved in it. So it's an AI CEO, DAO, operating it. Now, this is likely more of an experiment than, they're not betting the whole company on it. This is one division of the company, but it's a new exotic idea that I'm keeping a close eye on to see what's going to come of it.
Hopefully AI won't take over every one of those roles for obvious reasons. Okay, actually we're out of time, so we're gonna have to wrap up now, but thank you so much. It was really interesting to meet you all.